Welcome back to DataBytez, your source for data-driven content. Today we are discussing the topic of wealth, how to pick stocks like a billionaire. Now, we all want to be rich, or at the very least, we don't want to be poor. And one of the best ways to do that, to accomplish that goal, is to invest, to utilize the financial markets we have access to. Now, if you can tell, this video is going to be quite long, and that's because picking stocks is pretty complicated, especially when, I want to say complicated, but it's pretty involved. I think that's the better term. And especially when you want to pick stocks like a billionaire, not like the masses. So that way you can hold on to your money and really enjoy the fruits of your investment, not really feeling that kind of anxiety that some of us, or a lot of us feel, I would say, that when things kind of go wrong and we're like, what did we do? What am I doing? Kind of thing. You'll have a strong framework by the end of this in order to move forward with confidence, in order to invest soundly. So the billionaire that we really are modeling ourselves after here is none other than Warren Buffett. Now, if you don't know who Warren Buffett is, quite simply, he is the greatest investor of all time. Or I say in modern history. He's worth nearly $150 billion, and his incredible success in investing has earned him the title the Oracle of Omaha, because he's from Omaha, Nebraska. Now, something important to note is that Warren Buffett did not just wake up the greatest investor of all time. No. He learned from others. Specifically, he attributes his investing success to the great Benjamin Graham for teaching him how to invest the right way. And before we get into who Benjamin Graham is, let's read what Warren Buffett says about Benjamin Graham and how important he is. This also kind of covers his thoughts on investing in general. So, to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. Whether you achieve outstanding results will depend on the effort and intellect you apply to your investments, as well as on the amplitudes of stock market folly that prevail during your investing career. The sillier the market's behavior, the greater the opportunity for the business-like investor. Follow Graham and you will profit from folly rather than participate in it. To me, Ben Graham was far more than an author or a teacher. More than any other man except my father, he influenced my life. Strong words, strong praise from Buffett. And you can see he reiterates topics that we've discussed in previous videos on wealth. And I'll link it somewhere here where stratospheric IQ isn't required. It's not unusual business insight. It's not, you don't need to be that smart to invest well. What's really comes down to is having control over our emotions, having control over our impulses. And the best way to do that is to make things automatic. Whatever plan that you do, just make it automatic. The more automatic you can make it, the better. The less you have to think, the better. The less you have to feel, the better. Just you want it to be working in the background for you. And that's really important. And again, the other part here is that Ben Graham, Buffett says it himself, he influenced his life immensely. The only other person that he could think of, any other man that could think of that influenced his life so much was his own father. So that leads us to ask now, who Benjamin Graham is. Well, Benjamin Graham is the author of The Intelligent Investor. Now, some of you might know this. It is considered the greatest investing book of all time. Born in 1894, Benjamin Graham was a British-born American financial analyst, economist, accountant, investor, and professor. Along with publishing The Intelligent Investor, you can tell this guy really understood how money worked. He pioneered the revolutionary concept of value investing, rejecting Wall Street's inherent speculative nature, and he earned the moniker the father of value investing. It is the last revision, which was written around, again, 1975, if I haven't mentioned that I'll be quoting most things from. Most of what you'll see in this presentation will be coming from that revision, and that's the one that you see here. So before we start really diving into the principles, I want to have an important note here. And that is, I really want to stress this discussion is for the enterprising types that are dead set on investing in individual stocks. For 99% of people, the best investment strategy is the simplest. Graham's recommendation, and I agree with this one I kind of actually like it more than the general one of just VU, because it kind of gives you some variability here, some spread, is that it's a adjustable 25 to 75 investments split between stocks and bonds. The adjustment is based on market conditions and preference. Maybe you like the security, the perceived security of bonds a bit more, or maybe bonds are seeing a higher return because interest rates are high, or maybe the stock market's going down and so you want to kind of lock in more discounts. Whatever it is, you get that kind of leeway to adjust as market conditions go. For stocks, you want to deal with a low-cost index fund like Vanguard's VU, constituting the biggest portion of your portfolio. For bonds, you want to deal with treasury bonds. And again, this should be automated as much as possible. Some words of wisdom from Graham. The art of investment has one characteristic that is not generally appreciated. A credible, if unspectacular result can be achieved by the lay investor with a minimum of effort and capability. But to improve this easily attainable standard requires much application and more than a trace of wisdom. If you merely try to bring just a little extra knowledge and cleverness to bear upon your investment program, instead of realizing a little better than normal results, you may well find that you have done worse. Even the majority of investment funds, with all their experienced personnel, have not performed so well over the years as has the general market. Allied the foregoing is the record of the published stock market predictions of the brokerage houses, and there is strong evidence that their calculated forecasts have been somewhat less reliable than the simple tossing of a coin. In other words, beating the market is hard. More often than not, we are punished when we try to get a little smart about it. Because you have to understand, even Wall Street, with all its resources, access to the brightest and smartest MBAs and financiers and analysts that they have in the world, cannot reliably beat the market at scale. There's just too many moving parts for our mind to comprehend. It's too non-linear. And as we've talked multiple times, that our brain likes to think in linear ways. Now, is it impossible to beat the market? No, it's not impossible. But like Graham says, it amounts to a coin toss. Part of it is luck. Now, there are frameworks to increase the likelihood of that, and that's kind of what we're focusing on here. But the real takeaway is that your goal should not be to beat the market here. You're not going to get 1,000% return and change your life overnight. No, that's not what investing is about. That's far more speculation. And there is a difference between the two. Investing is kind of a long-term strategy. You want to see growth over time, and you want to just your investment to be secure. Because we really want to avoid loss at all costs. Loss is horrible. How horrible? Well, again, more words from Graham. I know we're not getting to the principles just yet. But here's what he has to say about loss. Once you lose 95% of your money, you have to gain 1,900% just to get back to where you started. Taking a foolish risk can put you so deep in the hole that it's virtually impossible to get out. Again, loss is terrible. If you have to work harder to get your money back than to lose it. I think that's really the takeaway here. And if his words are not enough to scare you away from loss, from foolishly choosing securities, then I have one other source. And this is my personal favorite book when it comes to finance. That is The Richest Man in Babylon, written by George S. Clason. This was written around the time Graham wrote his first issue of the Intelligent Investor. And what he says, or what he writes: every owner of gold is tempted by opportunities whereby it would seem that he can make large sums by its investment in most plausible projects. Often friends and relatives are eagerly entering such investment and urge him to follow. The first sound principle of investment is security for thy principal. Is it wise to be intrigued by larger earnings when thy principal may be lost? I say not. The penalty of risk is probable loss. Study carefully before parting with thy treasure, each assurance that it may be safely reclaimed. Be not misled by thine own romantic desires to make wealth rapidly. This was, I think, it far more resonates with me. I just like the way it's written. I like it's the way it's presented more. Just don't be tempted away by get rich quick. Don't listen to people saying, oh, invest here, invest there. I remember with one company I worked, one of the owners was telling my boss to be like, oh, give me money here. We're gonna put it in here, and it's gonna go so high. We're gonna make all the money back. I'll make you 20,000 if you give me 5. And funny enough, that was in, if I remember the name of the bank right, it was First National Bank or First. It was the bank after Silicon Valley Bank collapsed, and there was like speculation that it might come back, it might ended up not closing, but he believed it was gonna pop off, and nope, it ended up shutting down. Ended up being bought by Chase, if I remember right, and anyone who had stock in that bank, well, stock was worth nothing. So you get people tell you what to do with your money, where you're gonna get the fastest return, the highest ROI. Be wary. Don't be fooled. Riches take a long time to accumulate, and that is what Graham espouses. It's a long-term strategy, and that's the most reliable one out there. So we can finally define value investing. So the core idea behind value investing is to find stocks that are trading for less than their intrinsic / book value. In other words, their market price is lower than the company's value. In other words, this means you are buying the company's stock at a discount. This discount is what Graham refers to as the margin of safety, and acts as a buffer to help protect investors, you, me, from errors in their valuation and market volatility. This is a long-term approach that goes often against what the analysts suggest to buy. So when we can do our own example, when we kind of walk through his analysis methodology for stocks, you're going to see that what the analysts say is a good buy, Graham is going to say no. His method of analyzing securities is going to tell you that it's not a good buy, that it's too expensive. And when things get too expensive, they are a lot more susceptible to the ebbs and flows of the market. When people start believing, all of a sudden, you know what, it's not actually worth that much. Well, it was never worth that much to begin with, because people were just propping it up. So it's much better to just find them at discounts where people think it's worth less than it actually is, less than the actual assets that are there. And it'll kind of make sense more as we go through his principles. So without further ado, we can talk about the principles. So Graham's principles for the defensive intelligent investor. Now, I believe there are 6, 7, something like that. And the first is adequate size. The next is a sufficiently strong financial condition, earning stability, dividend record, earnings growth, moderate price to earnings ratio, and a moderate price to assets ratio. So that's what? 1, 2, 3, 4, 5, 6, 7. 7 principles. Now, the defensive investor is just one who is weary of losing their money, as we all should be. We don't want to lose any of it. And we're going to examine each one of these principles in more detail. Now, before we continue, a few things of note when discussing Graham. I've changed a little bit of changed some things from his original work. I've updated it slightly. And part of that is adjusting for inflation. Again, the last revision of Intelligent Investor was written in the 70s, and that is a far time away from where we are now. Money's worth something different. So adjusting for inflation is part of that's been what I've updated. And the second part is I've kind of generalized his guidance a little bit just for firms. So when Graham wrote his final revision of the Intelligent Investor, the tech sector wasn't really a thing. It was kind of blossoming. It was becoming. I think it was written in 1975. I think that was around the same year, or maybe 72 or 73, something like that, that the Apple II came out. The very first actual viable personal computer. Until before then, all computers they would take up like an entire room or even multiple floors in order to function. And the other part was the NASDAQ, an index fund that's kind of based on technology and innovation, had just formed in 1971. So it was a blossoming sector. And if there's something that you should really understand from Graham, is that he didn't really like going into hype. So in the modern context, things like large language models, AI, machine learning, these buzzwords that companies like to use, Graham wouldn't go for it. It's all hype. And you could see that whenever someone talked about, at least for when OpenAI really announced ChatGPT, any company that was like, oh, we're going to use AI too, saw their stock go up. And that kind of Wall Street speculation, that inherentness that you see things rally behind, is what Graham was not about. He did not like that. He went against that. And so he had no reason to push tech, to say, oh, tech is going to be the next first thing. He stuck to what was tried and true, which was the industrial sector and public utilities. He really liked public utilities. And one final note before really diving into these principles individually is that it's important to remember, and something his principles kind of touch on, is especially the latter ones that we'll see, is that when you buy a stock, you are buying a portion of a company, and you have certain rights, and you can expect certain things from the company you invest in, and you have certain rights. Now, those rights increase the more you buy, and when you buy over 50% of a total company shares, you actually can really start making decisions there. And most of us will not buy that amount. That's a lot of money. But think about it like Elon Musk, right? He bought all the shares of Twitter. Twitter was publicly shared, and he made it private. That's possible when you buy enough. So it's just important to remember, when you buy a stock, you are actually buying a portion of the company. So moving on to our first principle, adequate size. Firms should have at least 700 million in annual sales, and for public utilities, 355 million in assets, to avoid high-risk smaller enterprises. Now, this principle is pretty straightforward. You just don't want to invest in small enterprises, because without sufficient sales, without sufficient assets, you are more prone to the ebbs and flows of the market, and you don't want to risk your investment being lost because the company you're investing in doesn't have enough stability. Next principle, a sufficiently strong financial condition. Firms should maintain a 2-to-1 current ratio, and their long-term debt should not exceed net current assets. Public utilities debt should not surpass twice the stock equity at book value. Now, I'm not going to go too deep into what these financial ratios are that Graham is discussing here, like what a current ratio is and all the net current assets, all these kinds of things. That's more of another video, and I'll have that linked somewhere here, where we discuss these financial ratios, what they mean, how they're calculated, and how to interpret them. And then we'll have another video link somewhere here when we're actually analyzing a security on our own, and see how this can be kind of automated, so you don't have to think about it so much, and you can kind of just plug away. But the importance of this principle here, a sufficiently strong financial condition, because you just want to ensure you're investing in a responsible and resilient company. They shouldn't be borrowing more than they can pay back. As an analogy, imagine you had a friend who was deep in debt, who was always spending their entire paycheck before it even hit their account. It was already spent before the money was even hitting their account. Would you expect them to pay you back? Would you expect them to pay you back with interest? Of course not. They're bad with money. And that's what this principle is about. Weeding out the companies that are bad with money, who are borrowing too much. So that way you can ensure you're getting something back. Now, earning stability. Firms should have generated earnings every year for the past 10 years. Another straightforward principle. You don't want to invest in a company that loses money. You want a proven track record of profitability, so that's what we're checking for here. Dividend record. A continuous dividend payment record for at least the past 20 years. This is Graham's probably most stringent requirement that's going to eliminate a bunch of companies. 20 years of unbroken dividend payments. Graham's philosophy is that companies are obligated to disperse dividends to investors. Failure to do so is often unacceptable because, as he cites anecdotally in his book, that oftentimes when companies hold on to the cash from their earnings, they invest poorly. And so there's a big burden on these companies to prove that the money is better spent or better withheld from investors in order to actually generate growth. And they need to show that. They really need to show that with strong results. In fact, Graham feels so strongly about this principle alone, this dividend record, that he says that you can just make this the single defining trait, and that could be sufficient. If you don't want to go into too much analysis, just the fact that they've been paying dividends, consistently increasing it at a certain rate, and we'll talk more about the rate later. But he kind of holds a certain rate threshold that he finds acceptable. And yeah, you could use that just alone. And the other reason he finds dividends so important is that because investors sometimes live off that. Sometimes people live off the dividend alone as a collection of stocks that they have. And that's a great strategy for passive income because it doesn't require a lot of work. Is that they just live off the dividend. And again, harping back to the fact that most companies misuse this unpaid out dividend, holding on to the earnings, he likes that companies have a imposed financial discipline on them. They have to get creative and make every dollar count more because they're limiting how much cash they actually can work with because they're paying it out. And so when a company holds on to their dividend, it usually ends up result in throwing away money from the investor's point of view. And in fact, in the materials of this presentation, this lecture, whatever you want to call it, you'll find a list of about over 53 companies that have been paying dividends for at least 50 years. So that can help narrow down your search if you want to just use that as an example. Based on Graham's evaluation, it might be good, but you're going to have to make that call in there. This is just kind of, again, this is not really investment advice. It's just more, this is the kind of framework that Graham wrote about in his book, Intelligent Investor. And I feel that there's value here to share for you. And that can just help narrow down your analysis. Now, earnings growth. There should be a minimum 1/3 increase in per share earnings over the past 10 years based on 3-year averages. If you're not growing, you're dying. It's a rule of life and it's a rule of business. Obviously, we would all love our stocks to grow at insane rates, but Graham's has a 33% over a decade as adequate. It's important to remember that business is a marathon, not a sprint. Quick rises are often followed by quick collapses. Consistent, steady growth growth is often more preferable to meteoric rises. Now, moderate price to earnings ratio. The stock price should be no more than 15 times the average earnings per share of the past 3 years. Remember, the core behind value investing is the avoidance of overpaying for stocks. While the previous principles focus on a company being strong and sound, being in a strong financial position, we are now moving on to evaluating if we are overpaying for the stock. Our first tool here to make this evaluation is the price to earnings ratio. And again, we're talking about earnings per share. Graham's prescription is not choosing a company that has a stock that exceeds 15 times its average earnings in the past 3 years. The issue when this multiplier gets too high, the price now becomes more susceptible to volatility. Why? Because the company is believed to be worth more than the actual income it generates. It's kind of like the US dollar. It's the belief in the company's future. And it's in the belief that the company is going to continue to grow that is fueling its price. It's not the actual value underlying in the asset. It's not the actual profit it's generating. Now, it's important to note that if you buy the stock when it is at a good moderate price to earnings ratio and then it explodes after, that's great. That means you can lock in some sweet profits if you want to. It's only a problem before you buy because that indicates it's probably too expensive. So it all depends on if you're in before it shoots up or you're in after. And this, in the same vein, it's a moderate price to assets ratio. The stock price should not exceed 1.5 times the last reported book value with a combined multiplier product of earnings and price to book ratio not exceeding 22.5. That's a lot of words here, a lot of numbers, but essentially this principle boils down to this test. Is the stock price worth a lot more than the actual amount of money, land, buildings, all the things that make up the company's assets on the balance sheet? If the stock price is too high in relation to that, again, kind of like the belief that its future growth is going to be is fueling its price. Here it's again the belief that it's worth something is fueling beyond what it's actually worth, what it actually has in the bank, what it actually owns. And that really leads you to overpaying. And so these are the core of Graham's principles, but we are not done. He has some additional ones that I think are important, but they are not really the core of what make up the defensive intelligent investor, the person who is really doesn't want to lose money on his investments. No. We have a few more. And what are they? Well, general long-term prospects, quality of firm's management, financial strength and capital structure, and dividend rate. So let's kind of start diving into each one of these. These are their additional 4, which are important. So general long-term prospects. The intelligent investor should be able to answer 2 questions. What makes this company grow? Where do and where will its profits come from? Now, these questions seemed pretty simple, but this is a very loaded slide. And we're going to spend quite a bit of time here because this has much more depth than you would imagine. So obviously the natural questions is, how do we answer these questions? The question is how to answer these questions. Well, the answer is unsurprisingly reading. While we haven't touched on it too much, a necessary component for this entire analysis is the annual 10K filings done by every publicly traded company. A publicly traded company is any company that has a stock available to purchase on a public major exchange. So if you can buy a stock, it's publicly traded. They are legally required to post every year these 10Ks and can be found using the electronic data gathering analysis and retrieval system by the SEC, known as the EDGAR. And the SEC is the Security and Exchange Commission. There's going to be a link somewhere on another video I did on how to use the Edgar, how to use Edgar, how to access it, how to conduct searches to narrow down what you need. Because there's quite a few things that these companies are kind of required or to post or post supplementary materials for investors to consume. Now, the SEC is the governing body charged with protecting investors and ensuring all companies accurately and truthfully present their business and present financials in accordance with GAAP, generally accepted accounting principles. Whenever you hear about a company committing financial or securities fraud in a way that misleads investors, the SEC is the first one to step in and investigate. It's something important to note that these 10K filings are long, really long, often 100 plus pages, and you need to read them. Reading them is very important. Do not think you can get away without reading them. Funny enough, Warren Buffett recommends reading 500 pages every day for those seeking success because he believes reading builds knowledge like compound interest. And unsurprisingly, Graham's suggestion when considering to invest in a company is going through at least the last 3 to 5 years of 10K filings. Is it a coincidence that this more or less lines up with his star protege's recommendation? Because, 3 to 5 years, that's about 300 to 500 pages. I don't think so. I think Warren Buffett ended up reading that much. I think it's something along the lines of he reads the 6 to 8 hours a day because he's again, Graham's star protege. So he's reading these 10K filings. I don't know if he reads them nowadays, but I'm sure when he was starting out, he was reading these annual filings, these things that were printed out to figure out what companies were doing. And so before, whoa, went a little too far here. Hang on one second. Before we move on away from this slide, we're going to talk about some red flags here that Graham talks about when looking at a company. So if the company is a serial acquirer, constantly buying up smaller companies at an average of more than 2 or 3 a year, you should be wary of their underlying fundamentals. If a company would rather buy the stock of another business than invest in its own, probably you should do the same. Clearly something is up. If the company is addicted to OPM or other people's money, run. Fat cash infusions from banks or investors make it seem like a business is growing, but often it's just hiding the fundamental fact that the business is not cash positive. And finally, if a company depends on one or a handful of customers for most of its revenue, look the other way. If those few customers stop buying, the business won't survive. Now with the green flags, strong brand recognition, near monopolies, economies of scale, unique intangible assets, and resistance to substitution are all great things for a company to have. Think of things like Google for search or Coke for soda. Those companies hold a strong position in their respective space that they are not going anywhere anytime soon. And again, back to growth. Growth is consistent and steady. Again, business is a marathon, not a sprint. So a long-term growth rate of 10% is solid. 15% is ambitious. Anything beyond a company is liable to burn itself out. So while we all want to get rich, again, it's just not the way business works. And the company that sows and reaps is a great thing. What Graham means by that is that in a company that invests in R&D and sees tangible benefits is something you want to see. Something important to note that more is not better. In the long run, a company that spends nothing on R&D is just as bad as a company that invests too much in R&D. Again, this was a very loaded slide. I think this is probably the longest slide we spent on, but it's important. And these questions are loaded. What makes a company grow and where will its profits come from? Now, quality of firm's management, another aspect here. A company's executives should say what they will do and then do what they said. Again, sounds straightforward, but how do we hold management accountable? Again, we need to revisit the 10K filing. In every 10K filing, management provides some sort of guidance. This includes the current state of the business, where they foresee the business growing and new plans to expand or maybe plans to retract. Failure to provide guidance is a big no-no in the business world, since it introduces uncertainty, and investors hate uncertainty. I wouldn't even say investors hate uncertainty. It's more speculators. People are the ones that are antsy and quick to jump ship at the slightest inconvenience. If you truly believe in your fundamental investment, you shouldn't be so antsy just with a little bit of uncertainty. But a lot of people get antsy. So without guidance, no guidance is a big no-no. Good managers should admit their failures and take responsibility rather than blaming scapegoats like the economy. Everyone loves blaming the economy. Good management does not do that. We can complain about the economy, but people who are getting paid a lot of money to navigate a business need to adjust. They need to find solutions, or they need to admit their own failures. If they blame uncertainty or weak demand, no, unacceptable. Be mindful if their tone and substance stay constant or fluctuate with the latest fads on Wall Street. Again, if they're all of a sudden hyping up AI, large language models, machine learning, big data, if they're just using buzzwords that really get a quick rise in their stock, maybe they're not the most integritous of management. Some additional questions, again, that Graham puts forth that we should be asking. Are they looking out for number one? Be vigilant for highly unjustifiable pay in management. Unless there's a very good reason, it suggests the business is run by the managers for the managers. Something topical that recently happened. Elon Musk couldn't get his, what was it, like $58 million payment package for Tesla approved. I think it was the highest payment package for any CEO in America. And it was blocked by, I think maybe it was a Delaware court. I don't remember exactly. But that would be something Graham would say kind of gross. Maybe he would justify, maybe he would think Elon Musk is a great management, but it is an exceedingly high payment package. 2, are they managers or promoters? Executives should spend most of their time managing, not engaging with the public or on press runs. So if they're really in front of the public, they're really trying to push, they have a very public face, they're really well known like that, they're probably not good. That means they're not really managing. They're not really doing what they're supposed to do. That's something more for PR, not for the executive team. And finally, are the company's accounting practices designed to make financial results clear or opaque? For example, are extraordinary items so frequent that they seem ordinary? Do they use accounting jargon and like nonsense acronyms? I would say nonsense, but jargon acronyms like EBITDA or pro forma earnings instead of net income to hide losses? If they are, chances you should run. Now, I have another video on the core financial statements. Many links in this video to many different topics because, again, it's kind of involved. It's the culmination of a lot of different things. If you want to invest in individual securities, you kind of have to do a good chunk of analysis. And you need to know things in order to do that analysis properly. Like the core financial statements, looking up 10Ks, using Edgar, all these other things, financial ratios, blah, 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 blah. Otherwise, you wouldn't know what EBITDA means. It would mean earnings before incomes, taxes, depreciation, and amortization. Or pro forma earnings, which is kind of just like, I don't even really know what a pro forma earnings is. I didn't really learn that about until reading Graham. But it just seems like nonsense. It has nothing to do with the core financials that are posted on a 10K. So there's just a lot of things that you need to learn. And thankfully, you can find them all linked here. And now, moving on to the next thing. Moving beyond just having integritous management, we are looking at the financial strength and capital structure. So, the firm follows the golden rule of business. It generates more cash than it consumes while carrying minimal debt. This principle is straightforward. Any company that diligently adheres to this principle is virtually guaranteed to grow in value in the long run, regardless of the ebbs and flows of the stock market. Firstly, any successful business should be cash positive. If a business cannot generate cash consistently from its main operation, it is doomed to fail. Secondly, a business should not be so leveraged, a fancy way to say in debt, that it finds its earnings keep going to payment obligations, that it's just barely keeping up with its payments. For this, we need to inspect the balance sheet. This is where this information would be held. In general, long-term debt should be under 50% of total capital. Additionally, we need to verify that its debt has either a fixed or variable rate structure, and also the overall structure of its debt. Most of us know things like, fixed payment, we pay per month, but there are more options for debt in the business world. Things like balloons exist where you might not make any payment, and at the end of 10 years, you have to pay it all back in one lump sum. So there are different options that exist. So being able to read the footnotes of the 10K to understand how this structure works, if there isn't just a huge bubble that's going to burst in the near future, is important. Or if the rates are going to change, or I should say, if the Federal Reserve decides to change the interest rate, all of a sudden the company can't afford to service its debt. Again, this is somewhat topical. Yeah, there's a lot of topical examples to prove from, because it's been very interesting in the world of business and investing in cash. Because when the Federal Reserve began raising interest rates, a lot of businesses suffered. In fact, the raising of interest rates contributed to the infamous collapse of the Silicon Valley Bank in 2023. See, tech startups are notoriously over-leveraged. A lot of the times, venture capitalists or whatever, they pour money into these companies, these tech startups, in the hopes that they'll make money. So they get loaned out big chunks of money because someone believes their app could blow up. And the thing is, when they do blow up, it makes a lot of money because apps, technology, code has a very, very high margin of return, has a very big return on investment. The problem is you never know when that investment's going to happen, if it ever happens at all. So they just pour money into it, because especially when interest rates are low. And it was easy to afford the debt, but once the Federal Reserve started raising interest rates, these tech companies, which were the big clientele of Silicon Valley Bank, ended up needing to pull money from their account in order to service a ever more burdensome debt that was variable. It's just an interesting way of how cause and effect, how things are nonlinear, how you wouldn't imagine how tech companies having to pay their debt more can contribute to a bank collapse. But it's just the way the cookie crumbles, right? And so it's important that your company that you're choosing to invest in has a good capital structure. That it's not underwater and it's going to crumble at just another percent going up. And then finally, the dividend rate. Shareholders should demand of management either a normal payout of earnings on the order of 2/3 of net income, or else provide clear evidence that the reinvested profits have produced a satisfactory increase in earnings per share. Again, Graham is a big believer that companies should pay dividends. And now you understand the rate of which is about 2/3. That's what he believes. Now, Seems like a lot. I haven't really done the analysis myself to figure out how many companies adhere to this. But this is what he likes to see. It's kind of just more like a rule of thumb. And again, failure to pay a dividend is unacceptable unless they have clear proof that they are using the cash well. So the burden is on the company to show. So are you seeing more than what Graham would say is like a 10%? Are you seeing on the order of 15%? Are there competitors who are paying out the same kind of or a higher dividend, who are actually paying out a dividend? Are they seeing similar rates of growth? So that means they can achieve that growth while paying out a dividend while this company cannot. Chances are that you should probably not go with them and go with the one that their competitor, assuming that they match the rest of the criteria. What Graham believes is that when a company doesn't choose to pay out a dividend or tries to pay out a very low dividend, it's to hide its weak financial position. Again, this goes back to kind of hiding the mysteries about their financials, obscuring the truth. There can get some pretty creative accounting out there where business will look either cash strong or has a high amount of income, but in their notes they'll say, this is assuming this, or this is because blah 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 blah, and they'll explain it away and you just see the number without the context, and you assume that they're doing great, which is actually not. So companies can be very shady in their presentations with financials, and they're just kind of going through the loopholes of how they can present things without incurring the ire of the SEC. That's why accountants get paid a lot, because they're trying to, they're like, how make sure our financials look great. That's how they earn their paycheck. It's not actually presenting as accurately as possible, unless presenting as accurately as possible look great. But even then, they're going to want to fluff it up a little bit to even make it look better, because you got to have high earnings per share. But that is the final additional point. Now, we've covered a lot in this video. There was a lot to take in here that I couldn't really find an appropriate way to break up. So it kind of ended up being this whole big thing. So a quick recap of everything we've covered here in Graham's investment principles. The core principles are adequate size, a sufficiently strong financial condition, earning stability, dividend growth, earnings growth, moderate price to earnings ratio, moderate price to asset ratio. Oh God, I can't speak anymore. When it comes to adequate size, we're looking for a high amount of sales. It should be at least 700 million in sales and at least 355 million in assets for public utilities. For a strong financial condition, we are looking for a 2-to-1 current ratio with long-term debt not exceeding current net assets and public utilities not surpassing twice their stock equity at book value. And earning stability, we want earnings generated for the past 10 years without any negative or no earnings at all. For a dividend record, at least 20 years of past dividend payments, which again, Graham believes so strongly that you could just limit things down to this one if you really wanted to. If you didn't want to do the rest of the analysis to kind of build a basis of a list of companies to invest in, you should still be reading their 10Ks. You should really have a strong understanding of the fundamentals of the business to see, again, the additional principles, where it's going, what its market viability is. That should also be your concern. Earnings growth should be a minimum of 1/3 increase per share over the past 10 years based on 3-year averages. Moderate price to earning ratio. Stock price should be no more than 15 times the average earning per share for the past 3 years. Moderate price to assets ratio. The stock price should not exceed 1.5 times the last reported book value, with a combined multiplier product of earnings and price to book ratio not exceeding 22.5. Oh, and supplementary principles here. General long-term prospects, quality of firm's management, financial strength and capital structure, and dividend rate. So when it comes to the supplementary, when it comes to the supplementary principles, I promise I will hold it together until we're done here. We are very close to being done. When it comes to general long-term prospects, the intelligent investor should be able to answer 2 questions. And those 2 questions are, what makes this company grow? And where will its profits come from? And part of that, again, all comes down to reading the 10K. Does the company look like it's in a strong position to continue? For instance, let's have a quick discussion here. When the digital camera came out, do you think, or especially when cameras started being on phones, if you were around at the time, would Kodak look like it had good long-term prospects? And again, for those who don't know, back in the day, Kodak was the largest or the biggest company out there when it came to pictures, because you had to take a picture with a dedicated camera and go develop the film at one of their film developing things. I don't know what you call them, like the booths or something. And so it was a whole thing. And then all of a sudden you could just take a picture on a phone and just have it there. Would you think that the company that requires people to buy a thing, go to a place, pay someone to develop it, was going to survive? Even if they had the best management saying, oh, we're going to do this and increase all this. No, general long-term prospects are not good. So knowing where it's going to go is important. If you see things going down, probably it's time not to either not invest or jump ship. Quality of firm's management. Executives should do what they say, or executives should say what they will do and then do what they say. Easy peasy. Have some integrity. Financial and capital structure. Your company should not be in debt. The company you choose to invest in should not be in debt, and also make money. Easy golden rule of business. Make money, don't carry a lot of debt. And dividend rate. Management should distribute a typical portion of profits on the order of 2/3 of net income. If they fail to pay out a dividend or pay a very small dividend, they need to provide very strong evidence to justify that low payout. Now, in closing, all of this should drive home the fact that choosing stocks is hard. It is very, very time consuming. There is a lot to it. For 99% of the population, you're better off following Graham's initial prescription, a 25 to 75% automatic split between stocks and bonds. For stocks, you're picking something like a low-cost index fund like VU, Vanguard's VU. And for bonds, you are picking treasury bonds and even municipal bonds. I'll throw that in there. Municipal bonds are a great way to split. And you can have a little bit of play money to be a little bit speculative, because I'm not going to lie, being a little bit speculative is fun. Just say, I think this is going to go up. And then you have fun if it does. If it doesn't. If it doesn't, you're okay. But it shouldn't be the main part of your investment strategy. And this really highlights the fact that what Graham said also at the beginning, that to increase better than average returns, better than the market, requires a significant investment in time, in thought, in evaluation, in reading. It just requires a lot of time. Now, some of you out there who enjoy the mental challenge of doing this kind of analysis consistently and reading, or maybe you're a fast reader, by all means apply these principles and you will not go wrong. Me personally, I do not want to dedicate this much time to things. I'm going with the 25-75. But some people like to do more, and they can achieve very good success. There are people. I mean, look at Warren Buffett. I'm no Warren Buffett, but you might be Warren Buffett. You might be the next great oracle of wherever you're from. So Apply these principles. Again, I have a lot of links to the other parts of this if you don't know. If you don't know certain aspects like the financial statements, the core financial statements, how to use Edgar to calculate 10Ks, and many more things I discussed here. You should have seen links throughout the video. I might include them here at the end too. Maybe I'll have them across the screen. I'll think about it again. But stay tuned. The next thing will be actually conducting this analysis, and you'll have a tool that I made where it's able to at least kind of do a lot of the math part for you. It won't be able to read for you, unfortunately. You might be able to, if you pay for it, use ChatGPT, but I guess I'm babbling now. I've already gone for nearly an hour. I should probably stop this. But thank you for listening. If you made it to the end, I hope you got value from this. As always, stay data-driven. That is what DataBytez is about. And until next time, I hope you have a great day. Patrick out. Bye.